today I want to look at the closing entries. So this will help you with your project and really going through all of this information. So what we see is the Sewn for You adjusted trial balance. Now I did add a drawing account and change the amount in cash so that we could go through all of those closing entries that we need to go through, which is that REID or REID element. So what we see when we look at this particular adjusted trial balance is we see everything's grouped because it is by account number. So we see our assets up top, we see our liabilities, we see our equity accounts, we also see our revenue and our expense accounts listed. And so really what we look at here, all of these accounts right here are what we consider to be a permanent account, and those amounts are not going to close. Everything under capital account, these are considered temporary accounts, and these are going to close, and we need to make those a zero balance. Now notice I didn't put capital in there. Capital is a permanent account, but it will change in value with our closing entries because we are pushing everything into that capital account. When you get into companies that are corporations, you would see different accounts, and we're going to get into that in another chapter in the future. But you would see accounts like retained earnings, and you would see your capital would then be common stock and paid-in capital and things like that. But when we're just dealing with a sole proprietorship, we would just have that capital account that we're dealing with. So in looking at these particular entries, the other things that we're going to look at in just a little bit also are some of these statements. And what we'll find is, and one of the things I've said before that you can do is you can draw a line right here with capital, and it just kind of gives you some of that information as well. Everything above this line, that is going to be the balance sheet information that you're going to be looking at. So when I look at closing entries, we're just going to push it up because we just really want to be looking at these temporary accounts. And what we have here is we do need to close these temporary accounts. And again, the way we do that is through REID. So that's REID, revenues, expenses, income summary, and drawing. So the first thing we have here is closing out that revenue account with that R. So the only revenue we have on this particular one is fees earned, and it is for $225. Now we could have a lot more out there if we had different types of earning accounts, but for this particular one we only have the one. So right now that is sitting as a credit balance. To make that zero, we need to debit that account. And so what we would have here is we would, you know what, I don't really want to do it on this one. We would go back to our ledger because all of this should be on our ledger. So, but what we would have is we would have that fees earned account, and then we would close that to a new account that we have, which is the income summary account. And with that, we would be looking at these particular amounts that you see here. But I do want to put that on our general journal sheet. And so in putting that in, it just goes right underneath your other entries that we've been doing. So right underneath those adjusting entries is where we would come in. We would put the 31st because closing entries are done on that last day. And then what we would see here is we would have those fees earned, and it would be for that 225. And then you would have your credit account, which would be that income summary account for 225. Now the other thing that we see here that we need to close out, the next one is that E. So E is start for those expenses. So we would go from rent expense, supplies, depreciation, utilities. That is all of these guys right here. In doing that, I'd come down and skip a line again. And the first thing I'm going to write in here is going to be that income summary. And the reason for that is these are all debit accounts. So since these are debits and we need them to be zero, we would have to credit all of these, and the closing account would be that income summary account. So in looking at this information, what I would have is I would have a rent expense. I would have a supplies expense, and these expenses have to be listed out individually. I would have a depreciation expense, and I would have a utility expense. And so what I would see with all of this information, I am going to come back to that amount in just a minute. I just want to go ahead and put all of these amounts in. So I have 750, I have 300, I have 50, and I have 125. And notice I'm just taking all of these that are on that debit side and I'm putting them over here on the credit side. The next thing to do is just add all of those amounts up. And when I add these amounts, I take the 750 plus the 300 plus the 50 plus the 125. And what that gives me is 1225. And so that 1225 would go in that space right there. So now we are at the point where we've done the R, we've done the E, and so now we have to move to the I. And in looking at the I, what we have to do is we need to look at a T account in this particular case for income summary, because that I stands for income summary. And so with that, what we're going to be looking at here is, notice that we have a credit to income summary for 225. We have a debit for 1225. In looking at that, what that tells us is that we are at $1,000, and it is on that debit side. So when we get ready to close this particular account, what we are looking at here is, and I'm just going to go right underneath this and kind of put the 31 there. What we're looking at is closing this account out. So if it has a debit balance, that means that the income summary is going to have to be our credit for this particular one. Now this one is going to fluctuate. These two pretty much always look the same as far as income summary goes, but the income summary here can be the debit or credit. It all depends on this particular balance, because remember, we want to make all these accounts zero. So the letter R for revenues, we want to make all the R's 0. The E for expenses, we want to make all the E's, the expenses, 0. I for income summary, we want to make income summary 0. And the account that we close this out to is our capital account. And so what we would see here is we would see the capital for 1,000, and then we would see that income summary for that 1,000. And that pretty much gives us what we have for this I entry. Now the last thing that we see is the D. And for the D entry, what we are looking at there is the drawing account. So we would have to go in and look at our adjusted trial balance again. The income summary is the only one that we don't look at the adjusted trial balance for. And what we find is that the drawing account has a $1,000 debit in it. So if we want to make that a 0, what that means is that the drawing account, and what I'm going to do is we're going to call this, general journal, page 2 is what we're going to call this right here. So what we do with the drawing account is, again, we're going to list out that date of the 31st. My credit account would be drawing, and this again is going to close to that capital account. So capital is going to be my debit account. I still have, all of this, listed out here as far as my credit accounts and then my debits and all. And so what I have for this capital is going to be that, 1,000, and the drawing is 1,000. Now, it is just a coincidence that these numbers are the same. They're not generally going to be the same. They will be different. This is just the income summary number happened to be 1,000 and the drawing account happened to be 1,000 for this particular case. And so that is going to be that D account. So this is where we look at, we've got it in as far as our closing entries are concerned. The other step that you have in this process is the posting of these accounts. And so we'll come in, first one we have to look at is that fees earned account. And in looking at fees earned, we have a debit of $225. And so we would look at fees earned. This is on the 31st. This is still page 1 of the general journal. And the debit account here is $225, and that is going to leave me with a 0 balance in this particular account, because 225 minus 225 is 0. This is account 401, and so I would come back over here and I would place that 401 there. The other one we see is the income summary, and on this one the income summary is going to be the credit for 225. So I would go into, and the other thing that you want to put here on these particular entries is closing also. So I'd come in, it is January the 31st. This is a closing entry. This is on page 1 of the general journal. And for this particular one, we have a credit of $225. which would give me a balance of $225 on that credit side. This is account 320. So I would come back here and I would post in 320. For 31, what I would be looking at for this particular one here, back to the income summary account for $12.25 in that place. So I would have the 31st. Again, this is a closing entry. GJ1 for $12.25. And what that's going to do is that's going to give me a debit balance of $1,225 minus $12.25. Bigger number is what we look at on where it's going to go. The bigger number is the debit, so it will be on the debit side. And that's account 320. So I'd come in and put 320. Then I get to my expenses. So I have a rent expense that needs to be closed. So that's going to happen on the 31st, and I'm going to have closing. That is also on GJ1. It is closing with a credit for $750, which is going to leave me with a zero balance, and that's account 502. My supplies is another account that's closing, so it's on the 31st. I have closing. Now, if I do this off of account number order, then everything should flow and be, that next account and should be in order. So I have supplies expense. $300 is what I would be looking at, and that's going to leave me with a zeroed out balance, and that's account 503. The next one is that depreciation expense. The depreciation expense here, $50. So I have January 31st closing. It is on page GJ1. Credit of $50, which leaves me with a zero balance, and that's account 504. And the last one is utility expense for $125. So if I come down and look at my utility expenses, this was going to happen on the 31st. It is a closing entry, was found on page GJ1, credit for $125, and that zeroes out that particular account also. Now the reason we do this is to get ready for the next period, and it's usually done at the end of a year when we do the closing entries. So we can get ready to do our statements, we can close out the accounts. These temporary accounts need to go to zero because when we start a new year, we don't need a balance in those accounts. We just want the year that we're looking at for those particular accounts. And so that finishes closing out the E portion of this. So we've closed R, we've closed E. That is account 512. So I do need to make sure that I put it down over here so that I know that I have posted that information. The next things that I look at here is the I, which is capital and income summary. So the capital account is what I'm looking at next. And so this was going to be on that 31st. This is a closing entry, and it is found on page 1. And for this particular one, it will be $1,000. So I have a credit and I have a debit, so I would have to subtract, and that is going to leave me with $19,000 because that $20,000 is bigger. It's still going to be on the credit side. This is account 301, so I would post that number in, and then I would look at that income summary for $1,000. So I'd come back over here. That is the 31st. I am trying to close this out. It is on the first page. And so what I have here is I have a credit, so a debit and a credit for $1,000 means that this account is closing out also. That is account 320. So I will come back over here and I will put in 320. So now we're almost finished with these items. The next one I have on page 2 of the general journal. And I see capital and drawing. So I would go back to that capital account on the 31st. I would have a closing entry here. This is on page 2. So now it's going to be GJ2. And that is also going to be for $1,000. And that's going to take my balance down to $18,000 here. And what I have is the 301, so I'd come back up here, put in that 301, and then I have that drawing account that I'm looking at, and so I'm looking at that drawing account, I would come in here and I would put in the 31st. This is a closing entry. This is on page 2 of the general journal. It is a credit, and so that's going to take this account down to a 0 balance. So at this point, my revenues are my expenses, E, my income summary, I, and my drawings, D, should all be 0 in my ledger when I finish posting these, and that is account 310, so I don't want to forget doing that. And when we go through and we look, what we find is that the drawing account is in fact 0. Income summary is 0. My revenue accounts are 0. You know, when looking at, you know, my expense accounts, what I'm going to find is that they are all at 0 balances. So I now have zeroed out all of my temporary accounts, and all I am left with is my permanent accounts. And so what I see with what accounts I have left, as you can see, I have my cash account left, I have my accounts receivable, I have my supplies, and I have my prepaid rent. I did not have any prepaid insurance, but I do have equipment, I have accumulated depreciation, I have accounts payable, I have notes payable, I have unearned fees, and then I'm going to have my capital account here. And notice that the capital amount changed. Now with the closing entries, the only thing that changed on this, these first accounts, is that capital count. You know, everything else under capital goes to 0, capital changes, and then everything above capital stayed the same. And I did go in and put the entry in for that drawing so that our balances do match also. And so that's really what we're looking at and what we see as far as the closing entries go. I am going to come back and we're going to look at doing the balance sheet, income statement, and the statement of owner's equity in a later video.